Hello, my fellow silver and gold stackers. Welcome back to Gold Rush Reporter, the place where we break down the silver and gold markets, not just in price, but in strategy, supply, and global impact. Before we dive in, make sure you hit that like button, subscribe, and leave a comment with your silver price predictions for 2026. Today, we're talking about a market that has just crushed expectations this year, silver. It's now officially the third most valuable asset in the world, and China has just made a move that could reshape the global silver market for years to come. So, what exactly is happening? Why is it important? And what does it mean for investors and industries worldwide? Let's break it down. First, we need to step back and look at the bigger picture. Gold and silver serve very different purposes. Gold is about trust in money, about reserve currencies, and what backs them. China has been quietly building the Shanghai Gold Exchange for decades, expanding what some call the gold corridor. They are publicly buying gold to show the world that a monetary system outside the US dollar is possible, one that can be backed by gold and used as collateral to develop economies. This is strategic, deliberate, and sets the foundation for a multipolar monetary system. Silver, on the other hand, plays a different role entirely. It isn't about trust in money. It's about controlling a critical resource that powers modern civilization. From solar panels to electric vehicles, data centers, military electronics, and satellites, silver is one of the best conductors on Earth, and industries cannot pause production if silver prices rise. This creates inelastic demand, meaning the market reacts differently than traditional commodities, and it's why the last few decades of price suppression have been so significant. Over the next decade, the demand for silver is expected to skyrocket, driven by applications like AI, robotics, automation, and the technologies governments want to control. And China, which controls much of the refining and processing of silver, now has a powerful say over who gets access and who does not. This story is bigger than just silver rising in price. It's about strategic control over a critical material. By reclassifying silver under dual-use export controls, China now dictates who can access this metal. This is not a ban. It's a regulatory strategy that positions China as the gatekeeper of the global silver supply. The country's influence over refining infrastructure, contracts, and processing means that even silver mined elsewhere could still be under Chinese control before it reaches end users. Next, let's talk about how the silver market functions and why this matters to investors. The US COMEX is the main futures market, with silver divided into eligible and registered categories. Eligible silver is stored but not for sale, while registered silver is available for delivery. Currently, registered silver in COMEX vaults is only about 120-130 million ounces, less than 10% of global annual demand. Most contracts are rolled over or cash settled, meaning physical delivery is rare, but when participants want their metal, supply is tight. Shanghai silver prices, which reflect physical delivery in China, have recently traded higher than COMEX prices, showing a 6 per ounce gap, a rare premium indicating constrained physical supply. Arbitrage, the mechanism that usually aligns global silver prices, is failing because the metal isn't freely moving. This is a clear signal that the physical market is tightening, while paper markets in the West are still dominant. This dynamic is critical for investors to understand because it signals a shift from normal market behavior. When physical silver becomes harder to access, factories cannot stop production, and governments cannot pause strategic projects. This isn't speculation. It's about real-world demand outpacing supply. Historically, silver has sat dormant for years and then surged rapidly when demand constraints hit, sometimes doubling in price within months. The current situation in China, combined with global industrial and strategic demand, means the conditions for such a surge are forming once again. Investors need to be aware, not just of price, but of control, availability, and geopolitical strategy. Now that we understand the role of silver versus gold, let's look at the historical context of China and silver. For most of modern history, China's economy ran on silver. Taxes, trade, and big transactions were denominated in silver by weight, not by face value. This made silver the backbone of their economy for centuries. Between the 1500s and 1800s, vast amounts of silver flowed into China, establishing the country as one of the largest consumers of silver in history. Access to China's production often required silver as payment. This created a system where silver wasn't just money. It stabilized incomes, prices, and economic activity. However, the 1930s exposed the vulnerability of this system. In 1934, the United States passed the Silver Purchase Act, forcing its government to buy huge amounts of silver. This caused silver prices to rise sharply and drew silver out of China. The deflation that followed destabilized the economy. Prices dropped, people stopped spending, and investment dried up. The lesson China learned was clear. Depending on a material you don't control leaves your economy vulnerable. By 1935, China moved away from the silver standard to paper currency, a strategy to protect sovereignty over economic resources. This lesson remains central to China's strategy today. Fast forward to today, China is applying that historical lesson in reverse. They have reclassified silver under dual-use export controls, meaning a material for civilian use can now also be restricted for strategic or military purposes. This doesn't look like a ban on paper, but practically, almost no foreign entity will qualify for export licenses, giving China the ability to control the global silver supply. Combined with their dominance over refining infrastructure, China can decide who gets physical silver and who doesn't. This is especially powerful because most silver production comes as a byproduct of mining other metals like copper, zinc, and lead. Production cannot simply be ramped up, making supply inelastic and vulnerable to bottlenecks. This move mirrors what China did with rare earths over the past decade. Rare earths are essential for electric motors, missiles, wind turbines, and advanced electronics. China restricted exports, prices surged, and governments scrambled to rebuild non-Chinese supply chains, a process that took more than 10 years. Silver, unlike rare earths, is used almost everywhere. Solar panels, semiconductors, electric cars, military technology, and data centers all depend on silver. And because the supply is tightly controlled and demand is inelastic, any restriction in exports can have immediate global repercussions. The financial implications are equally significant. Western markets, particularly COMEX, operate largely on paper contracts. Only a small fraction of silver is actually deliverable. Meanwhile, Shanghai reflects physical silver availability in China, and the market has recently traded $6 per ounce above COMEX, a massive gap by historical standards. This is a warning signal that the paper and physical markets are decoupling. Arbitrage mechanisms that usually balance prices are failing, indicating constrained supply and increasing premiums for actual deliverable silver. Investors should understand this is not a normal market fluctuation, but a reflection of strategic supply control and industrial demand that cannot be postponed. Silver's importance as an industrial metal also amplifies geopolitical influence. Unlike gold, whose demand can be deferred, silver must be used. Factories cannot pause production because of price spikes, and governments cannot delay projects. This makes silver a strategic choke point, giving controlling countries like China immense leverage over global manufacturing and industrial capacity. By controlling silver, China isn't just influencing prices, it is controlling who can produce, who must wait, and who will need capital to continue operations. This is power, and it is exactly why investors must track not just price movements, but strategic supply flows. Let's dive into how this supply control could impact global markets. Silver's inelastic demand means that price increases aren't self-correcting. When demand is urgent, factories, data centers, military production, producers must buy at any cost. This differs from commodities like coffee or oil, where consumption can slow if prices rise. In the case of silver, essential production lines cannot pause. Therefore, if China restricts exports, the price can spike rapidly, creating a global ripple effect across industries. This is why the Shanghai COMEX price gap is significant. It signals constrained physical supply and rising strategic importance, reflecting China's ability to dictate market access and pricing. For investors, this creates a unique environment. Speculators and industrial users alike are now competing for a constrained resource. Historically, silver's price has been volatile, with periods of dormancy followed by rapid surges. For example, in the late 1960s and 1970s, silver doubled multiple times. From 1979 to 1980, silver went from roughly $6 per ounce to over $50 in just over a year. These spikes were driven by sudden shifts in supply-demand dynamics. Today, we see similar conditions forming: strategic restrictions, constrained supply, and industrial inelastic demand. Unlike traditional financial assets, silver reacts to physical necessity rather than speculative desire alone. China's control over refining amplifies these dynamics. Even silver mined outside China often passes through Chinese processing facilities. Export approvals will be strictly managed, meaning foreign buyers may struggle to access metal even if they have the financial means. This is a strategic chokehold that mirrors rare earths, but with far broader industrial implications. Every solar panel, EV battery, and semiconductor that requires silver is potentially impacted. Global manufacturing timelines, energy projects, and technological development can be delayed or priced higher due to controlled access. The West faces structural challenges because 70–80% of silver production comes as a byproduct of other metals. Unlike gold, doubling silver prices doesn't automatically increase output, since production is tied to other mining operations. This inelastic supply makes silver vulnerable to geopolitical control, and demand from AI, EVs, renewable energy, and defense applications is only increasing. For investors, this means physical silver, industrial stockpiles, and sovereign reserves will likely see growing premiums over paper derivatives. Physical control equals strategic leverage, and China now dominates that leverage. Another key point is investor behavior. Historically, paper contracts dominate Western markets, with only a fraction of silver physically delivered. However, when demand shifts to needing real metal, speculation accelerates physical scarcity. Arbitrage between paper and physical markets becomes ineffective, leading to dramatic price swings. This dynamic is now unfolding, highlighted by Shanghai trading premiums and constrained COMEX registered inventories. Investors need to monitor not just prices, but also inventory flows, shipment delays, and government export approvals. These indicators often signal supply stress before price spikes occur. Finally, the strategic implications extend beyond finance. Control over silver affects energy, technology, and military capabilities. Countries that cannot access silver may face production delays, technological bottlenecks, and increased costs. Meanwhile, China and its partners can prioritize domestic or allied needs. This strategic control creates leverage, influencing global trade, industrial growth, and geopolitical positioning. Silver is no longer just a commodity or monetary metal, it is a linchpin of industrial power in the 21st century. Now, let's consider the bigger picture of how China's silver strategy fits into global finance and geopolitics. Silver isn't just a metal anymore. It's a tool of control. By limiting exports and prioritizing domestic or strategic partners, China can influence who builds what, who delays, and who must negotiate to gain access. This is not theory. It's a direct consequence of historical lessons. China experienced firsthand in the 1930s what happens when a country relies on a resource it does not control. They lost silver, deflation hit, and the economy suffered. Today, the lesson is flipped. Control the supply, and you control industrial and economic outcomes on a global scale. Industrial demand is central to this. Unlike gold, silver cannot be substituted or postponed. Factories, data centers, solar energy producers, EV manufacturers, and defense industries all rely on a constant supply of silver. When supply is limited, production can't slow down. It must continue at any cost. This creates a market where industrial buyers are price insensitive in the short term. The result? Prices can spike very quickly, and speculative money joins the party, magnifying the movement. This is why physical silver in Shanghai is trading above COMEX. The market isn't just pricing speculation, it's pricing scarcity and strategic control. Western markets are exposed. COMEX-registered silver inventories are shrinking, and most Western traders only hold paper contracts. When the market shifts toward physical delivery, Western buyers risk being sidelined. Even if they have the capital, getting physical silver may take time and approval, especially when China's dual-use export rules are in effect starting January 1st, 2026. This creates a scenario where industrial demand, strategic control, and investor demand collide. Silver is no longer a sleepy commodity. It's a bottleneck metal. And bottlenecks rarely correct gently. Historically, silver reacts in phases. Periods of dormancy can last years, followed by rapid surges when demand shifts or supply constraints appear. For example, silver's price stayed subdued for decades before the late 1970s spike, which was sudden and explosive. Today we could see a similar dynamic. Strategic stockpiling by nations and corporations, combined with investor speculation, could push silver prices higher in months, not years. But volatility will remain extreme. Investors must be prepared for sharp swings and short-term corrections, even amid a strong long-term story. Another consideration is the global industrial ecosystem. Roughly 70-80% of silver production is a byproduct of other metals. This means production cannot easily increase to meet rising demand unless base metal mining also ramps up. Supply is inherently inelastic. At the same time, China controls much of the refining infrastructure. Even if silver is mined elsewhere, it often passes through China before becoming usable. By controlling refining and export approvals, China can influence who gets access and when. This isn't just about price. It's about leverage in production, technology, and even national security. From an investment perspective, monitoring both industrial demand and strategic movements is critical. Physical supply is now a key driver of price, more than paper contracts or futures speculation. Arbitrage opportunities between Shanghai and COMEX have highlighted this decoupling, showing the market is shifting from financialized paper silver to tangible, deliverable metal. Investors who focus solely on paper prices may miss the true market signal. The lesson is simple. Scarcity plus inelastic demand equals high volatility and strategic importance. Finally, let's discuss what this means for investors, industries, and global markets moving forward. Silver is no longer just a commodity. It is a lever of industrial and geopolitical power. As China begins implementing dual-use export controls, Physical silver will be increasingly concentrated in the hands of strategic actors. Industrial users who need silver cannot wait for prices to fall, and foreign governments or companies may face shortages unless they negotiate directly with Chinese authorities. This shift elevates silver from a financial asset to a critical strategic resource, which is unprecedented in modern markets. The inelastic nature of silver demand means prices can spike faster than most assets. Industries, sovereigns, and large investors will compete for the same ounces. Historical patterns show silver can double or triple quickly when these conditions are met. For example, 1979-1980 saw silver move from $6 to over $50 per ounce in just over a year. Today, with additional industrial demand from AI, EVs, renewable energy, and defense, the potential for rapid price appreciation is significant, but volatility is inevitable. Spikes are often followed by sharp corrections as speculative money rotates to other opportunities. Investors must also consider the difference between paper markets and physical markets. COMEX is largely paper-based, with only a fraction of silver available for delivery. Shanghai reflects actual physical metal in China. Recent trading premiums of $6 per ounce above COMEX illustrate a growing gap between financialized silver and physical silver. This decoupling signals that strategic supply is becoming constrained and market dynamics are changing. Arbitrage is no longer smoothing prices, meaning physical shortages are beginning to impact global pricing. For industries dependent on silver, the implications are profound. Solar panels, semiconductors, EVs, and military applications all require physical silver. Supply constraints could slow production, raise costs, or force companies to negotiate for metal directly. This makes silver a bottleneck metal, and bottlenecks rarely resolve slowly. Governments and corporations alike will need to plan carefully to secure supply, further pushing demand for tangible silver over paper derivatives. Finally, from a global perspective, China's move represents more than just commodity control. It's strategic leverage in a multipolar world. By controlling silver and other essential materials, China can influence industrial output, technology deployment, and even economic relationships. Combined with gold accumulation and a growing role in global financial systems, China is positioning itself to control both the trust in money and the resources needed to power modern economies. In conclusion, silver is now at the intersection of money, industry, and geopolitics. Investors should track physical supply flows, industrial demand, and strategic moves closely. Volatility will be high, but the opportunities are equally significant for those who understand the dynamics. Control over silver means control over production, pricing, and even national security. The lesson is clear. This is no longer just a market for traders. It's a strategic game that could reshape industries and global power balances. Stay informed, monitor physical supply, and understand that silver's story is about far more than price. It's about control, leverage, and the future of industrial and financial power.